Welcome back to the Deep Dive. We're digging into China Automotive Systems, CAAS, today, looking at their Q2 2025 results from that pre-market call.
That's right. And our goal here is, well, to try and make sense of something. Management sounded really quite bullish, operationally speaking.
Yeah, they did.
But then you look at the stock the next day, and it was, let's say, underwhelming, a slight dip even.
Right. So mission today, to figure out why that confidence didn't quite translate and, what the real story is for investors.
Exactly. Where's the disconnect?
Okay, let's start with the basics, the numbers they put up. Operationally, things look pretty solid. Revenue hit $176.2 million. That's up, 11.1% year over year. Pretty decent.
Not bad at all in this climate.
And GAAP diluted EPS was $1.25. Just a tiny beat over last year's $1.24, but still positive.
Right.
And the operating income, that showed some real leverage. It jumped 20.2% to $13 million.
Okay, so those numbers, they definitely paint a picture of momentum, things moving in the right direction operationally.
Yeah.
But the sticking point, and you could almost feel it coming, was the gross margin. It contracted, fell 120 basis points compared to last year, down to 17.3%.
Ouch. And investors these days, they really zero in on any margin pressure, don't they?
Absolutely hypersensitive. So that number, that 17.3%, it kind of casts a shadow over the good top line stuff.
I get that, but it feels like management was trying to push back against that narrative because they didn't just meet expectations, they actually raised their full year guidance.
Yeah, that was the surprising part, wasn't it?
Moved the full fiscal 2025 revenue target up from $700 million.
Yeah.
Now they're aiming for $720 million.
Which is, a pretty confident signal about future volume.
It really is.
And that's the puzzle, right? How do you get strong operating income growth, a guidance raise of over 2.8%? And the stock still kind of shrugs and drops almost 0.7% the next day.
So what's the theory?
Well, I think the market's basically treating CAAS like a regional supplier just churning out parts, focusing only on that immediate margin squeeze.
And missing the bigger picture.
Missing the, frankly, pretty radical strategic shift that's happening under the surface.
Okay, let's dig into that shift then. The core of it seems to be moving towards the high-tech stuff, particularly electric power steering, EPS. How's that going?
It's going really well. I mean, that's where the growth engine is. EPS sales specifically, they jumped 31.1% year over year.
Wow, okay.
Reached $72.9 million. So now EPS makes up 41.4% of their total sales. That's up quite a bit from 35.1% last year.
So they're actively pushing that mix shift. It's not just happening passively.
No, definitely not. They're aggressively repositioning, and that takes investment, of course.
Right, the R&D spend. They confirmed the full year guidance there, $30 to $35 million.
Which works out to roughly 5% of that new $720 million revenue target.
Is 5%. Is that enough, though? When you think about competing globally with the big tier ones, the Bosches, the ZFs, especially on complex systems like L2 plus steering.
It's a totally fair call. And maybe the absolute percentage isn't world beating, but you have to look at where that money's going.
Okay.
They specifically said 80% of that R&D spend is now focused purely on EV related steering products.
Okay. So heavy focus.
Extremely heavy. They have to, right? Given the market in China, management tossed out a stat, something like 1 in every 2 new cars sold there is now an EV.
Incredible penetration rate. So it's less a choice, more just survival and chasing the market.
Pretty much. And they did highlight a specific product win that shows the R&D is paying off, the second-gen IRCB system.
Right, the Intelligent Electro-Hydraulic Circulating Ball System. That sounds complicated.
It is, and it's for heavy-duty trucks. But the key things are it's L2 plus compatible, so it enables driver assist features.
Important for safety and future tech.
And they projected massive cost savings for fleets using it. Something like 36,000 RMB per truck per year.
That's the kind of number that gets fleet managers listening.
Exactly. That's how you win those big long-term contracts in the commercial vehicle space. Proven ROI.
Okay, so the tech is shifting. Let's look geographically, too. You mentioned they're moving beyond just being a China story.
Yeah, the diversification is definitely picking up pace. The Americas, in particular, showed really strong growth.
Brazil, right, that was a big one.
Huge. Brazil sales jumped 49.4% year over year, almost 50%.
Wow.
And Brazil now accounts for 10.1% of their total sales.
Significant piece of the pie now.
And North America was also up 11.8%. So you combine North and South America, and you're looking at about 27.5% of their total business coming from the Americas.
So definitely reducing that reliance on just the domestic Chinese market.
Rapidly. Which leads us to, I think, maybe the biggest headline from the call, the one the market seems to have totally ignored.
The European deal.
The European deal. Their first order for REPS from a major European OEM.
Okay, break that down. REPS.
Right. Rack-type electric power steering. This is the advanced stuff, directly controlling steering.
Not just components, the whole system.
Pretty much. And the order value, over $100 million annually.
$100 million a year. Starting when?
Mass production is scheduled for 2027.
Okay, 2027. That's
right.
That's a massive win. It feels like more than just revenue. It's validation, right?
Yeah.
A Chinese supplier winning a high-tech steering contract in Europe against the incumbents.
It's huge validation. It signals they've kind of leveled up. They're not just the value option anymore. They're competing on tech with the established players on their home turf.
Which brings us back to the awkward part, the margin. If things are going so well strategically, why did that gross margin dip to 17.3%? They must have addressed it.
They did, yeah. And the explanation wasn't exactly shocking, but it makes sense in the current environment.
Okay, what was it?
Two main things, both kind of macro pressures. First, increased tariffs. Obviously, not much they can do about that directly.
Right, external factor.
Second, the product mix during that specific quarter just happened to include more of their, let's say, relatively lower margin products.
So a temporary mix issue combined with tariffs.
That's the story they told. And honestly, it lines up with what we're hearing across the auto components industry. Pricing pressure is real.
But on the cost side, internally, they seem to be managing things well. G&A expenses were down significantly year over year.
That's true. They did show good cost control there, mostly driven by lower business taxes and surcharges, apparently.
Okay.
But interestingly, their income tax expense actually went up.
Oh, why was that?
Simple reason, really. Higher pre-tax income because the business is growing.
Makes sense.
Combined with expecting just a higher effective tax rate for the full year 2025 compared to what it was in 2024.
Got it. So more profit means more tax, plus a slightly higher rate expected.
Exactly. Now, underpinning all of this, the R&D, the expansion, handling these contracts like the big European one is the balance sheet. How are they fixed for cash?
That seemed like a definite strong point. They reported $135.3 million in cash and short-term investments.
Pretty healthy cushion.
Yeah, and operating cash flow for the first half of the year was solid too, $49.1 million.
So that cash pile, that's what lets them fund the R&D, right? And it lets them make big investments like, I think they mentioned adding a fourth EPS production line in Brazil.
That's right, yeah. Needed $3.5 million in CapEx for that to support that booming Brazil market.
See, that's the kind of move a strong balance sheet enables. You can invest proactively.
And that financial strength also seems related to another big decision they announced, changing their corporate registration, moving from Delaware to the Cayman Islands.
Ah, yes, the re-domicile. That always raises eyebrows, doesn't it? People sometimes jump to conclusions about transparency or, dodging regulations.
So what was management's explanation?
Their stated rationale was pretty pragmatic, actually. Primarily, they said, it's about cutting costs, reducing the overhead associated with being listed and reporting in the U.S.
Like specifically things like filing quarterly 10Qs. Those take a ton of work.
Exactly. Fewer filings means saving a lot on legal, accounting, and just internal compliance effort and money. Resources they can use elsewhere.
So they framed it as streamlining.
Pretty much. Streamlining for a company that's increasingly global. And they were very clear this doesn't change their NASDAQ listing. The ticker symbol stays the same, and it doesn't impact shareholder stuff like buybacks or dividends.
Okay, so purely an administrative move for efficiency, according to them.
That was the pitch. Make operations smoother for a global player.
All right, so let's recap. We've got solid growth, this really critical strategic shift towards high-margin EPS, huge international wins like the European contract, tons of cash, and an admin change to cut costs.
It sounds like a company executing well.
It does. And yet, the stock barely budged. So, what does this mean for someone looking at this? Let's get into our not financial advice segment.
All right. Disclaimer, firmly in place, not financial advice. But if I were walking into an investment committee meeting with this,
Yeah?
I'd argue the market's just mispricing this right now. It's laser focused on that temporary margin dip in Q2.
The near-term pain.
Exactly. And it's completely, utterly failing to factor in the impact of that massive European EPS contract that starts paying off in a few years.
So you're saying the market sees the 17.3% margin today, but it's ignoring $100 million a year in sticky, likely higher margin revenue starting in 2027.
That's the core of the disconnect. I mean, look, auto supply chains have long lead times. We know that. It takes years to go from winning a contract to actually shipping parts and booking revenue.
So the market's impatience is rational in a way, but the valuation isn't.
You could put it that way. It knows the revenue is coming, hypothetically, but it seems unwilling or unable to price it in until it's much, much closer.
So how do you play that potential mispricing if a payoff is years away?
Well, the trade idea, again, not advice, hinges on that timeline. Given you have pretty decent visibility on that $100 million annual stream starting in 2027.
Right.
The thought is maybe initiating a long-term, deep-in-the-money call option, something that expires after 2027.
Okay. LEAP, essentially.
Yeah, basically. The idea is to capture the potential re-rating of the stock that arguably should happen once that European revenue actually starts hitting the P&L and becomes undeniable.
That's definitely a patient strategy. What stops the stock from just drifting lower between now and 2027? What's the downside protection?
The floor, I think, is that balance sheet, that $135 million in cash and equivalents. We calculated it earlier. It's roughly $4.48 per share just in cash.
Okay, so a significant cash buffer relative to the likely share price.
It provides a cushion, yeah. The thesis is basically they navigate these near-term margin headwinds, maybe over the next couple of quarters. They hit that raised $720 million revenue target for the year.
Show execution.
Show execution. Then the market has to start taking that 2027 revenue more seriously. The catalysts are simple: hit the numbers and give positive updates on getting that European EPS line ready to go.
Okay, so to wrap up this deep dive on China Automotive Systems Q2 2025, it really was a tale of two stories, wasn't it? Strong growth on the top line, clear strategic wins with the EPS shift, and that huge European contract.
Definitely bullish on the strategy and execution front.
But all of that got overshadowed, at least in the market's immediate reaction, by that dip in gross margin, driven by things like tariffs and product mix.
Oh, yeah. And maybe the final thought to leave you with is this. Management raised guidance aggressively. They're pouring R&D into EVs. 80%, remember.
Oh.
So the question really isn't if they'll keep growing.
Okay.
The real question to watch now is when. When does the operating leverage from selling more and more of those higher margin EPS systems get big enough to offset the other pressures and actually stabilize or even start to reverse that gross margin decline?
That inflection point.
That's the moment. When that leverage kicks in, the whole story could shift pretty dramatically from, a value supplier story to more of a global tech growth story.
That margin stabilization point is definitely the key thing to watch going forward. We absolutely encourage you to keep an eye on how advanced steering tech evolves across the whole auto industry. Thanks for diving deep with us.
Catch you on the next one.